Yeah, I think the policy volatility and the whack-a-mole game of changing direction, on a literally hourly and daily basis is going to be the theme of the next few months. I'd say the number one request we're getting from investors is, when's the draft of any IRA revisions going to be available?
We're on our own DC timelines. Our cycle is just different. So fourth quarter, third quarter earnings, like we're at the second and a half week of the new Trump administration. So we're in this 100-day window where a new administration comes in and just blitzes the market, its sort of political base and corporates with news flow. And Trump is excellent at doing that. We've been trying to pull back all the noise, all the words, all the executive orders, and try and understand themes and then direction of travel. So thematically for this space, it's still our view that like over 4 years, the Trump administration's objectives when it comes to energy transition is, winning on energy dominance. So we define that simply as more, right? So it's more oil and gas, but it's also a lot more electricity. And at the end of the day, if you want more electricity, you have to be resource neutral. You might not actually, get to those lines of conversation when you're up on the podium, but you're going to need renewables in the near term to get to more.
I think the conventional wisdom on the street is that 45X survives. No one, I believe, is saying it's going to get repealed as part of that process, that surgical process you just described. And let's just bring it into a company. So I'm going to look at First Solar right now. They're trading based on consensus at an EV/EBITDA multiple of 6x. Broad solar market trading at 9-10x. So First Solar's trading at a discount, as part, and maybe folks could be speculating that, if that 45x goes away, that's a big part of their profit generation. And so, maybe there's some folks in the market who are looking at a company like this and thinking about that specific tax credit, and it's playing into the narrative of the company. So why does everyone think that 45X is so safe? I'm curious.
I think the biggest thing is that it was already scheduled to phase down in 29, go away in 32. So any changes to policy would take some time to implement, et cetera. As it relates to First Solar, I think investor concerns are, does the bonus tax credit of 10% go away? If so, that then would take away the premium price that they're getting for Made in America content.
Are we going to see more tariffs, less tariffs? Kind of how do you frame the tariff debate?
Yeah, I mean, it's, again, never a 0 or 100, but it's pretty close to 100 that we're going to see more.
Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about research and the latest developments in energy markets. Today, we've got a very different and special conversation because we're joined by two external guests that I think will be great for thinking about the future of energy. So we've got Jeff Osborne and John Miller, both from TD Cowen, on the research team there. They are, if you want to follow up with them, just how you contact them, do a quick bio on your Bloomberg terminal. They're green dots, shoot them an IB if you want to connect with them during or after the call. I will be monitoring the Q&A and chat, so if you've got some questions, pop them over and we'll try to work them into the conversation. So we are at the early days of the 4Q, our annual result reporting season. In phase was just yesterday. We had Vestas this morning. And so, Jeff, I want to come to you first. And, you don't have to go into any specific security if you don't want to, but give us your sense. How did, 2024 shape up? What does 2025 look like, when broadly thinking about the sort of clean energy landscape, in your opinion?
Yeah, I think the policy volatility and the whack-a-mole game of changing direction, on a literally hourly and daily basis is going to be the theme of the next few months. I'd say the number one request we're getting from investors is, when's the draft of any IRA revisions going to be available? But directly answering your question head on, Rob, and thanks for having us on. I think that the close of Q4 was broadly in line for both utility scale and residential. In Europe, residential and commercial solar is certainly rolled over pretty hard, excluding the UK. You see the monthly data out of Germany and some of the other markets. In phase last night talked about continued weakness in that region and sort of steady growth in the U.S. and steady growth in their eyes is sort of flat to maybe up 10%. I think the theme of utility scale, and you saw this with NextEra and some of the other utilities at both EEI and other events since then, is really just safe harboring and visibility. People are going to have a few years of lockdown demand. It's certainly a seller's market given AI and what's going on with utility scale power more broadly. And I think that was a big theme of the Next Tracker call. And as people look to safe harbor, I think that the order sizes will get bigger and over longer duration. So certainly have a bias towards positioning towards utility scale here relative to, say, residential and commercial. And then within residential and commercial, I think the themes will be around integrating batteries and ease of installation and, hopefully, knock on wood, lower interest rates in the weeks and months ahead.
I just have to follow up quickly because I do find it a bit ironic that the U.S. is a bright spot relative to Europe. And rhetorically, you might be inclined to think the opposite. We've got the incoming or the sort of recently started Trump administration, much more hostile to the idea of wind, certainly, but renewables generally. But it sounds like U.S. is actually a bright spot. How do you reconcile that with the sort of political conversation that's occurring?
Yeah, I mean, John can touch on this, but we've had a lot of executive orders, but not a lot of meat on the bone as to what the mechanics of any of these changes will be yet. And so people are still proceeding forward as business as usual, knowing that changes likely will come. And as changes come, there's usually an element of safe harboring that allows people to move forward with their projects and existing economics. And so I think that's created a bit of urgency, lighting a fire under people, so to speak, to move quicker where they can. Obviously, we still have the same three bottlenecks around labor of installation, transformer shortages, and interconnection issues that are still, governing, if you will, or throttling back the rate of success of some of these industries. I think you folks and others have written about the onshore permitting, is impacting a minority of the development, and certainly offshore wind is a bigger issue in my mind. That maybe the credits for EVs are something that Trump can have a bigger impact right away. But the base tax credit and a lot of the state policies are largely still in place and haven't been changed yet.
Fantastic. John, let's bring you into the conversation. And I gave a brief introduction, but John, you're based in DC.
Yeah.
Jeff just mentioned, what kind of changes could be coming from the Inflation Reduction Act? How would you frame the general DC landscape as it pertains to these kinds of questions?
Yeah, thanks so much, Rob, and thanks again for having us on. Just a little context on what I do and how it's different and additive to Jeff's side on the fundamental equity. We have a six-member team here in DC covering federal policy, trying to translate that narrative for institutional investors. So not delivering policy messages, not lobbying for any particular outcomes. We try to be resource neutral. A lot of it is just framing up, kind of, Rob, where you started, what's coming down the highway here, and what are the possible off ramps, and what could they look like. I really look at what we call the energy transition. So power, fuels, infrastructure, transport. If you rolled back a few years ago, it was ESG. Before that, it was sustainability policy, and before that was energy policy. So we've gone through this wheel again, and we're back to sort of energy transition policy. Awesome. We're on our own DC timelines. Our cycle is just different. So fourth quarter, third quarter earnings, like we're at the second and a half week of the new Trump administration. So we're in this 100-day window where a new administration comes in and just blitzes the market, its sort of political base, and corporates with news flow. And Trump is excellent at doing that. We've been trying to pull back all the noise, all the words, all the executive orders, and try and understand themes and then direction of travel. So thematically for this space, it's still our view that, like, over 4 years, the Trump administration's objectives when it comes to energy transition is, winning on energy dominance. So we define that simply as more, right? So it's more oil and gas, but it's also a lot more electricity. And at the end of the day, if you want more electricity, you have to be resource neutral. You might not actually get to those lines of conversation when you're up on the podium, but you're going to need renewables in the near term to get to more. The second key target for them is really winning on artificial intelligence. And that's not any secret. The derivative there is a lot more electricity to power the data centers, to power the hyperscalers, to get that done. So we're constructive on the concept from a policy framework of electricity demand, and there's room for both gas and renewables. Jeff mentioned transport, definitely a space where there's a lot of policy headwinds coming in that haven't even really gotten into gear yet. We can talk about that quite a bit. Energy infrastructure is where we've been spending a lot of time too as well. If you want to do any of this energy dominance, if you want to win on AI, you need to build new transmission lines, pipelines, compression, LNG, and all that goes through effectively the same process. And that's going to be hard. So we can spend time unpacking that. But obviously the big question, the question that almost every investor conversation starts out with, is the Inflation Reduction Act. Jeff's question of when are we going to see tax? And I mean, this is such a DC answer. We just don't know, right? This has not been a good week for certainty. House Republicans were meant to have a budget amendment structure in place today, this week, to understand how they could begin the reconciliation process. They've basically punted that because within their own caucus, they couldn't come up with that number. So kind of the earliest you could see legislative text is late March, early April, but it feels like all that is shifting out. We can go through on a credit by credit basis, but this is going to be a really difficult negotiation. The speaker keeps talking about surgical strikes, right? Not sledgehammers. And that's just representative of there's basically a two-seat operating majority in the House right now. A number of members have been pulled out to join the administration. Some are sick, some are fundraising. It's really, really narrow. So lots to talk about, but Rob, I'll kick it back to you.
I'm just curious to drill in on one specific credit there. So I think the conventional wisdom on the street is that 45X survives. No one, I believe, is saying it's going to get repealed as part of that process, that surgical process you just described. And let's just bring it into a company. So I'm going to look at First Solar right now. They're trading based on consensus at an EV/EBITDA multiple of 6x. Broad solar market trading at 9-10x. So First Solar's trading at a discount, as part, and maybe folks could be speculating that, if that 45x goes away, that's a big part of their profit generation. And so, maybe there's some folks in the market who are looking at a company like this and thinking about that specific tax credit, and it's playing into the narrative of the company. So why does everyone think that 45X is so safe? I'm curious.
Maybe I can start out with the politics of that, and then Jeff, you can translate that into how we think about the stock. Look, in the public policy realm, there's never zero and there's never 100%, right? So if anyone is telling you that, they're not going to be in their seat for very long because there's just tails to this space. What we've seen from House Republicans is they've basically carved out 45Q, which is on CCS, 45Z, which is for clean fuels, kind of replacing the BTS, the blending tax credits, and then 45U, which is a nuclear credit for a zero emissions credit. Those have effectively been carved off and firewalled as we don't really want to eliminate these. Everything else is still in the options menu, right? So there is risk. If you speak to Chip Roy, who's a very conservative member of the Republican caucus, he's going to say, get rid of all these credits and let's get to be deficit neutral in 10 years, which calls for really deep cuts across the board. That's one member of the caucus. You will hear those voices. They will introduce tax, and you'll see that red headline on the Bloomberg terminal, and people will have to respond to it. So there is risk there. I think the reason that where I am is that's not the base case. Twofold. One is just retail politics, the impacts of this credit in very narrow Republican district. If you're a member of the Senate, right, it's a full state. But if you're a House member, you're talking 350,000 individuals. So one large project from a tax base, economic opportunity, employment is really meaningful. So there's retail politics in play. We've seen that a couple times. You go back to June of last year, there's this infamous letter from a number of Republicans talking about being thoughtful repeal. Last week, Ways and Means had its Members Day. This is the tax writing committee. same conversation, right? No one really wants to be on the record saying defend 45X, but saying let's be thoughtful in how we approach this. That's kind of the language, thoughtful. So retail politics, and then just its structure itself. This isn't a credit where once you qualify, you get paid for a 10-year run like the PTC on the clean electricity side. It begins a wind down in the early 2030s. So it is not really as long dated and expensive from that perspective. The last thing you can do to that about that expensive side is you can add language that effectively really excludes China, Chinese entities, Chinese capital, and Chinese IP. So from a policy perspective, we're not taking away something that's breeding jobs. We're being tough on China, and it's not that expensive on the medium term. So that's where we end up, where we think this passes through the cycle. But there's a lot of debate, and I'll let Jeff take on the debate how it materializes in the stock.
Maybe just to weigh in quickly too.
Sure.
Because I think 45X is such a thing that gets discussed, but for anyone who's not in sort of the clean energy world, who's on the call, 45X is this manufacturing tax credit for basically making solar panels or wind turbines in America, that kind of thing. But Jeff, let's hear your read across on the companies.
Yeah, I mean, I think the biggest thing is that it was already scheduled to phase down in 29, go away in 32. So any changes to policy would take some time to implement, et cetera. As it relates to First Solar, I think investor concerns are, does the bonus tax credit of 10% go away? If so, that then would take away the premium price that they're getting for Made in America content. So today they report an ASP of 30 cents in the backlog versus what's flowing through the P&L today, which is largely made in Southeast Asia at 26, 27 cents. So that would impact profitability. But most investors I talk to aren't looking at it trading at 6 times EBITDA, as you framed it, Rob. They're looking at what does the core semiconductor business do in EPS in 2026? And that number is probably $10 to $12 in earnings per share. And then on top of that, you have the value of the 45X credits, assuming Alabama and Louisiana are ramped up and near full utilization. And that's how you can come up with a $26 to $30 EPS range. And so we use a DCF on the 45X credits and then add that to, a commoditized semiconductor multiple on top of that 10, 12 times, or 10 to 12 bucks of EPS, which to me is deserving of a sub-market multiple. So maybe 15 times that plus the $100. That's how you can say this is a $250 stock. But you can create some downside protection in that 140, 150, 160 range by saying if the credits were to go away and they're just, having success selling in America, the question is at what price? And that then gets back into John's world is like, will President Trump come in and put in foreign entity of concern labels on Chinese manufacturing? If we take away supply, really Hanwha and First Solar will be, two of the larger producers, excluding any of the Chinese. And you already saw Trina exit the market by selling the fryer. The question is what happens with some of the other Chinese that maybe are waiting for clarity on that policy.
Maybe just to ask a question too, to get your sense. I mean, so if you're buying a solar panel in the US right now, you're paying quite a big premium to the global market. So the global price for a solar module is sub 10 cents a watt. First Solar's got a big backlog locked in at about 30 cents a watt. And so generally, if you're buying panels in the US, you're paying a pretty big premium. And part of that is not the IRA, just table that for a second, and tariff and all of these things that I want to come to John on in a second. But what's your sense of what is the trajectory of panel pricing in the US? And where does First Solar or company or Hanwha or companies like them land, in that post-IRA world, assuming it just sort of naturally phases out according to the schedule of the bill, and let's assume 45X isn't touched. What's your sense of where U.S. pricing goes? Is there going to be downward pricing pressure in the U.S. long term?
I think longer term, yes, but I think in the intermediate term, call it next 12 to 36 months, I think there's an upward bias. And really, you have to say, why are we higher than the rest of the world? It starts with the anti-China stance going back 8-10 years ago, then the Uyghur Forced Protection Labor Act, then the circumvention case number 2, which had some clarity on the 29th of November, which seems to be supporting pricing a little bit higher. I think where there could be some downward bias is if there is more American manufacturing that is in place, and if either as part of the base 30% tax credit we require a certain content made in America, or that bonus adder is still there to provide a tailwind. But as long as we have an anti-China stance, and as long as we care about the genesis of silicon, I think the pricing, relative to the rest of the world, where those facets don't matter, will always be higher in the U.S. The question is for how long, and I think it's still going to take another 1.5 to 2 years, especially as we require cells, and that potentially may require wafers made in America in the future, which are obviously very energy intensive and very expensive. So that's why I gave you sort of the 18 to 36 month window with an upward bias, but hopefully longer term, we get that domestic supply chain built out of things like frames and glass and silver paste and other things that the Chinese have that we don't have here, that's impacting the price.
It's very interesting. I love the American manufacturing resurgence component of what you're talking about. John, what's your sense? Trump is it's very interesting on tariffs. I think he sort of generally likes them as a negotiating tool for sure, but are we going to see more tariffs, less tariffs? Kind of how do you frame the tariff debate?
Yeah, I mean, it's, again, never a 0 or 100, but it's pretty close to 100 that we're going to see more, right? We're going to see more. Clearly, this is a tool that he likes to leverage to achieve policy objectives within the trade space, and obviously policy objectives way outside the trade space. Fentanyl, like that, way outside the traditional trade space. But tariff is the tool to get there. Other reasons are this is extreme power that is hyper concentrated in the executive office. So we've seen this concentration of power, ignoring Congress whenever we possibly can. So this is a tool that he has, right? Lots of different levers. Go through all the numbers, right? 201, 232, 301, IEPA, all these things that allows him to decide who, what, when, where, and why, and then have the ability to end all that when he decides that said emergency or trade imbalance is done. So is more coming? Yes. What are some dates in this? The 18th, another offhand date, February 18th, that Trump tossed out last week, when he noted he'll be looking at the European Union and some sector-specific products. So think like aluminum and steel. Polysilicon could fall into that. There's been a big push in the trade community in DC to get a global 232 national security safeguard on Chinese polysilicon, such that you avoid this whack-a-mole language that Jeff was using, where the value chain moves from China to Taiwan to Southeast Asia to Africa, right? How do you get ahead of that? Any Chinese polysilicon is covered on the Uyghur Forced Labor Prevention Act or Section 232. April 1st, another key date. This is the date the Department of Commerce and the USTR, which is the trade representative, are to deliver reports to the Trump administration. Basically, this is where we are on trade. These are the toolkits we have. So that kind of unleashes the next rounds of 301. And there's the incremental back and forth with China in general, right? So while the 25% tariffs on Canada and Mexico were paused for 30 days. They have not gone away. They are paused for 30 days. The tariffs on China were not, right? And so they are beginning to move into effect. The Chinese countermeasures will come in on the 10th of February. So we're talking new tariffs on LNG, oil, gas, imports of some larger vehicles, including pickup trucks, obviously very targeted. So these things are happening. There's also the sort of trade action that's coming from the corporates themselves, right? So as a corporate, as a US manufacturer, you can express harm from international trade policies and ask for the opening of an AD/CVD investigation. There are a number of those already open. So there are AD/CVD protections, the anti-dumping, countervailing duty protections on China, Taiwan, circumvention through Southeast Asia. There's an open AD/CVD on Southeast Asia itself, which Jeff was just mentioning. There's an AD/CVD that's now open on graphite and anode materials, right? And that moved forward last Friday. So there's a lot of these pieces all happening at once. The last thing I'll say is that Trump is not supportive of domestic manufacturing for solar the way Biden was. He has a different view on it, right? So pros and cons, right? The cons are that he's not into accelerating the traditional energy transition narrative the way Democrats were. The pros are he's much more willing to, go after these value chains in China, where Biden was cautious. Biden was always very cautious about disrupting CSPV, particularly polysilicon imports, because he didn't want to see solar install numbers go down. He didn't want to see sales of EVs go down because of failed access to graphite. So he was sensitive to those numbers in a way Trump wasn't, right? He's willing to break that value chain and deal with that pain, because in his mind, that pain's not his base. So if you're a domestic manufacturer, that's kind of your view. If you go to SIA's website right now, which is the big trade association for solar, the big splash page is energy dominance, US manufacturing, right? So the entire narrative has changed around that. I think that's sticky and can hold some water.
Maybe, sure, I'll just weigh in that my general sense is that we're probably not going to be exporting much solar equipment in the near future, right? We can't. It's very difficult for an American-made product to compete with one in China, but we are exporting a ton of natural gas these days. Tariffs are a two-way street, and I wonder, does all of this discussion around tariffs come in and affect the dominance? The U.S. is now the world's largest LNG exporter. Does the potential tariffs being thrown up by other regions and countries towards the U.S. affect how you should be thinking about LNG in your mind?
So I can take a sort of a swing from the policy perspective. How it like pushes through the companies is going to be very, very interesting, right? And some of that negotiation at a company level, on a trade association level. So obviously traditional oil and gas also has exposures to value chains in China. A lot of it's from the steel perspective. It's used in piping. But yeah, I mean, so that the Chinese retaliation, I think, was lower than some were expecting, but certainly targets these key industries, right? You've also seen the Trump administration elevate LNG exports into the European Union as part of their conversation. So there's tools on both sides saying, buy our gas or tariff comes, we're not going to buy your gas. It's going to be interesting. There's also this is not a 2025, also likely not a 2026 issue, but there are, bubbles of conversation you see popping up on the extreme left and on the extreme right that really question, should U.S. hydrocarbons or refined products be sold to China as a strategic rival? I don't see that making its way into legislation that hits of even a committee at this point, but it's out there. It's like, why are we doing this? Why are we selling these things? So there's push pulls on both sides. There's also the concern about within energy dominance, right? If the narrative is more to drive down costs for consumers and for industrials, there's a concern about if you keep doing exports, what if those prices begin to elevate? And so this is a dichotomy within, a number of dichotomies within the Make America Great Trade platform and economic platform. And we'll have to see how that plays out. How long will Trump tolerate Henry Hub prices that go up? It's going to be difficult to see.
Fantastic. Jeff, I want to switch gears a little bit. You mentioned the idea of utility scale solar being, kind of a relative bright spot in the solar world here at the moment. And I think a big component of the build out in the US is growing electricity demand, which is a relatively new phenomena. AI is a big piece of that story. Just a few weeks ago at the White House, Donald Trump had Sam Altman, Oracle CEO, SoftBank CEO, talking about the Stargate initiative. And then only a few days later, we saw the DeepSeek announcement and saw a big sort of reversal in thinking, or at least a slight change in thinking in the markets on kind of where AI is heading, data center CapEx. So I want to do a vibe check with you on how to be thinking about this theme that seems to be unfolding particularly in America, but globally. How is AI affecting your thinking on the sort of clean energy space, and are clean electrons really sort of the preference, the priority? Like, how fast can you build, in your mind, solar versus gas or some of the other fuels and technologies you might choose?
Yeah, multi-part question there, but I mean the historically, and I think even the BNEF data would support this, but typically 15-25% of solar PPAs, their utility scale would have been data center buyers. And in my conversations, I think we'll hear more about this at Intersolar North America in a few weeks in San Diego, is it seems to be closer to 2/3 to 75% currently. Is data center oriented buyers. And so the nice thing is that they want power at really any cost. So you don't have the same Public Utility Commission scrutiny. The obstacles, if you will, aren't as prolific with data center buyers. So that's a positive for the sector moving fast. Solar still takes 18 to 24 months to build. You're seeing a bit longer. For wind, and storage can be a bit faster depending on the permitting, and pockets of the U.S. have some fire concerns and other things that have popped up here. But gas, the turbine, availability is the main issue. So as it relates to the scrutiny of how clean the electron is, I would say that's waning. Right now, it's a bit of a race to who gets to the goal first of having their data center built. I think you'll still see targets that are out there that might be met by buying RECs and other credits, and maybe the definition of green electricity is massaged over time. But gas is still a winner. I was at a power meeting yesterday, and if you want to build a gas turbine, the soonest you'll get is 29. I think in ERCOT and MISO, you can get solar up and running well before 2029, but California is taking 5 years for interconnection, timing. So, different parts of the U.S. are moving at different paces, unfortunately, Rob, and that's then having an impact on where data centers are being built. But if you were to look at a map of the U.S. and where some of the activity is beyond the logical suspects of, say, Virginia, it's really where there's excess gas. So Midland, Texas, San Antonio, Texas. Texas is really proliferated for both gas-driven data centers, but also off-site PPAs, for solar, wind, and batteries. And I think NextEra's call talked a bit about that as well. So I'm of the view that all of the above can win. I think it's a combination of both, not one or the other. Nuclear, obviously, SMRs are going to take even longer out into the 2030s, but that's certainly a big topic of conversation as well. But what's actually being constructed now, where PPA signed 18-24 months ago, prior to all of this sort of hype cycle, if you will, around AI.
Yeah, very interesting. There's a question in the chat from one of the clients participating related to Tesla's battery business, but maybe just to broaden it out a little bit, I think we're seeing an increasing number of solar projects include storage. And so, whether in the light of Tesla or sort of just storage generally, I mean, you mentioned it several times in your remarks just now, but, what role do you see storage playing? How competitive are batteries at this point on the grid? And I do think that there's probably some tension between sort of the gas world and the battery world that could be emerging. And how do you read the tea leaves on battery storage? Is it going to be a pretty big growth segment in the next 5 years?
Yeah, I think it's going to be a huge growth segment. I think the problem with some of these AI data centers is there going to be 20 to 50 to 100 hours a year where they want to curtail their load. And so, a Bitcoin operator can easily do that. A data center might be more challenged to do that. And so that's where you're seeing, a combination of gas that is not behind the meter with behind the meter storage. You're seeing utility scale storage and utility scale gas. You're seeing utility scale renewables. And gas. So again, I think there's multiple ways to sort of skin the cat and get to the firming that we need in resource adequacy, but also creating, a line of path for the local utility to have a stable and reliable grid. Obviously, states like Ohio and a few others are trying to create legislation around different tariff schemes that can protect themselves and ratepayers as well as the data center providers. Specifically to storage and renewables and Tesla's offering. I'm of the view that lithium still today is the vast preponderance of the conversation, 4, 6, maybe 8 hours in a good day. Specifically as it relates to Tesla, look, they thought they were going to build 3 million cars this year and last year, and they built 1.8 million last year. So they have a lot of extra battery supply that they had ordered, and they need to do something with. And so that's why they expanded capacity in Lathrop, California for the Megapack. They built capacity in China as well. And the auto bidder software that they have is probably one of the most underappreciated elements within Tesla. Obviously, you have a management team and a CEO that hypes every element of the story, but that's the one that actually comes up the least. But and Powerwall is a formidable competitor too. But Megapack is a very good offering that's clearly had success at scale in markets like Australia and Hawaii and others, and I don't think is worth dismissing.
Fantastic,
maybe
John.
Just like my 2 cents on this, right? And it's not as valuable as Jeff's dollar was on that, but like a couple things that have happened right through the Inflation Reduction Act and some regulatory reform has really opened the pathway for developers to think about batteries differently. Historically, really before calendar year Jan 1, 2023, you had to pair an energy storage asset with a traditional renewable generation facility to get access to the 30% investment tax credit. That was corrected through the Inflation Reduction Act. So now a standalone energy storage project can compete in a utility RFP to replace a legacy peaker, just like a combined asset, just like a gas turbine can. So the argument here is there's some additional tools on the tax credit side, but every project's a little bit different, right? And where you sit is how are you going to firm that resource, right? In a lot of places it'll be natural gas, in some places it'll be energy storage, in other places it'll be fuel cells and linear on site. And so it's all really depending on the baseload generation resource in that space, the access on the infrastructure side, what the commodity price is, and what you can actually do on the gas LDC side too as well, right? So there's all these conversations about, we'll just build a whole bunch of fuel cells. Well, that's going to require additional pressure, compression, dealing with the gas LDC. So there's just challenges across the board. So looking at that all-in cost and being able to offer that, right? That was one of the things that, not making a specific recommendations. That was one of the things the Constellation had done historically very well, right? They could always match a growing wind portfolio with their 24/7 nuclear, and so they're now trying to do that with their expansion in the Calpine side too as well.
Yeah, fantastic, John. I was going to maybe get your read on a related question. So I think Trump has said numerous things on this idea that if you have a big infrastructure project, billion or more, he would sort of issue the permits, right? Now, if you look at the executive orders, there's stuff in there about NEPA reform, which personally think could be pretty meaningful. But what's your sense on, is there a way for the Trump administration to accelerate, whether it's gas or solar? Jeff was just talking about 5 years plus in some markets to get capital in the ground. Is there a way to accelerate that? And how should the administration, if that's a goal of theirs, to move more quickly on getting things built in America? What's the best way to do it?
Yeah, no, we've been spending a lot of time on that, and apologies for the individuals who have to listen to this, because the energy infrastructure policy structure in the U.S. is really, really not sexy, for lack of better words. It's all of these implementing rules sitting on top of pieces of legislation like the National Environmental Protection Act, Endangered Species Act, Clean Water Act, Clean Air Act, and then all the implementation rules. So you mentioned the EOs, right? So there were 12 EOs on day one that basically impact the energy transition space. The most obvious ones are declaring the energy emergency, and then the unleashing American energy. And they have a lot of really aggressive, bold language about, for critical projects needed for national security or economic reasons, we're just simply going to waive environmental permitting requirements. That's just not legal. Like, you can do that. You can have Interior, Army Corps of Engineers, EPA issue all the permits, not do any of the background research. The challenge is local stakeholders or national environmental groups will challenge that order in court. The court will say you didn't follow the law and it'll get remanded back. So what we've seen so far from the Trump administration, to me, is not really encouraging, right? They're trying to go back to the process they put in place through the first term, which was kind of a mess. They're trying to take advantage of the fact that there's some real judicial questions about underlying legislations and this organization called the Council on Environmental Quality. Can it actually write rules? What needs to be done? There needs to be a legislative fix, right? And this was probably the biggest swing and a miss at the end of last year, December 2024. The Energy Infrastructure Permitting Reform Act of 2024, a bipartisan piece of legislation negotiated through then Senator Manchin and Barrasso, died in the House because House Republicans said, we're going to be in charge in 2025. Why are we doing a bipartisan deal now? They don't have the votes to bring that back. And so they can't institute the timeline reform. They can't institute the front end management of stakeholder issues, and they can't legislate on the back end judicial reform saying this is when challenges need to come in. If there's a remand, it needs to get done in this window. So those big ticket issues haven't been fixed to the legislative side. Trump will try through the executive order and regulatory side, but it's going to be very messy. I think 2025 is going to be a really challenging year for this space with a lot of litigation and a lot of projects slowed down. Hopefully, if we can put an optimist hat here in DC, 2026, believe it or not, is another election year. It's a midterm cycle. You're going to have a lot of at-risk Democrats and Republicans saying, okay, let's actually do a deal. And it could reemerge in that time frame, in that space. But for 2025, it just feels off.
All right, thanks, John. Before last question, just a quick bit of advertising. So next week on this call, we've got our utilities team joining. So Nikki Sue, Gabrielle Privatera, and Patricio Alvarez are going to join. So there's some questions about companies like Constellation. We'll go deeper on those next week and make sure to join that. Feb 26, for anyone who's in Miami, we're going to hold a small roundtable in our office with Mike McGlone. So based in Miami, you want to say hello, come have a coffee or a beer with me, give me a shout. We'll get you into that. And I was actually, John and I were just talking before we kick this off. I'm due to go up to DC sometime in 2Q. We'll have a roundtable there, and John's welcome to come. Jeff, you're welcome to join us there as well. And so anyhow, last question. So Jeff, big picture, hopefully this is a fun one for you. What do you think's exciting or potentially very exciting in the sort of broader energy transition landscape that doesn't seem to be appreciated by the market right now? So, what's sort of the most interesting thing that everyone else is missing, but you've got visibility on?
Yeah, I mean, I'd say over the next 18 to 36 months, you're seeing a lot of new policies at the state level support virtual power plants. So, if you were to look at companies like Enphase, SolarEdge, and Generac and say beyond the ability to grow your business, what is really differentiating you versus, say, commoditized Asian competitors? I would say it's the ability to integrate multiple distributed energy resources and manage them and have those electrons be valued in an appropriate rate structure. That's a complicated concept for investors, but it truly is, I'd say, the biggest thing that keeps Enphase's management team up at night is ability to differentiate themselves in the future. Obviously, Tesla has that with AutoBidder as a software platform to allow your vehicle to inject into the grid through V2G. There's a lot of cool things happening there. I would say there's a lot of innovation as well in new behind the meter assets. So obviously Bloom makes a lot of noise about that using natural gas, but you've got companies like Mainspring Energy with their linear generator. You've got Hyliion, which was 18 months ago focused on trucks, but they bought this random GE generator business called Carno. Don't cover the company, but and it's not even a commercially deployed solution. But there's a lot of innovation, is what I'm trying to say, around behind the meter power that isn't just a battery, if you will. To me, those are the two most important or interesting things going on. I would have said 2-3 years ago, maybe things in hydrogen are interesting, but that's a sector that hasn't really evolved for a variety of different reasons. So there's been clearly disappointments in sort of the new developments, if you will. And then lastly, just to throw a wild card at you would be, clearly interconnection and transformer shortages are well telegraphed by the industry, but the ability for people like Quanta, Mastech, and Primoris, names that my colleague Mark Bianchi covers, to actually have the labor to install is a problem. So you are seeing a big focus in the industry around sort of robotic assembly of solar farms. I think even Bloomberg's written some stories on that in recent months, more on the journalism side as opposed to the BI side. But that would be something to pay attention to. And, in particular for First Solar, given they have a frameless module, you want to make sure that doesn't end up being like a Fabergé egg with a bunch of robots handling something that is a bit fragile.
Fascinating. John, same question to you. What's your sense, if you're thinking about the DC landscape, what do you think might actually surprise us the most over the next 12, 18 months that could come out of Washington as it pertains to energy transition?
Yeah, I mean, I think that the most interesting debate in the dynamic space is that firming question that we were at earlier, right? So there's the new clean electricity tax credit, which will be reformed in some structure. Does energy storage stay as a standalone entity that can compete? Do Republicans reform some of that language to make fuel cells eligible again, right? So that would be an interesting trade that could take place too as well. So I think that you have baseload electricity coming from the grid. You want to maximize and optimize that for your own manufacturing or data center process. What does that look like? And so that feels like the most dynamic policy space. It's not just federal, it's also state and local. So that adds other layers, but there's going to be a lot of interesting decisions, policies, and investments around that.
Fantastic. Well, I know I've kept you a little bit past the time we agreed to, so thanks for hanging on and continuing the conversation. Again, for anyone who has follow-up questions for myself, Jeff, John, we're easily discovered on the terminal. Just look us up, shoot us an IB, shoot us an email. We're happy to follow up. And I want to thank you for your time. Join us again next week, and we'll try to have Jeff and John back on sometime in the future so we can chat more about this really exciting space. Take care. Have a great week, everyone.
Thanks
so much, Rob.